Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. One of the main objectives and missions that I've always had on this channel is really to try to cover every single covered call ETF provider, not only in Canada, but the US as well. And in Canada, not only just to show the ETFs and cover them and review them, but also to speak with the actual portfolio managers or CEOs of these companies. And I have to say, I'm very close to that goal of really speaking with everyone. And I'm happy to announce that in today's video, we were going to talk about everything CI. So CI Global Asset Management is a very big player in the covered call space in Canada and really in the ETF space in general. They're a very, very big firm, and I have absolutely the pleasure of speaking with the guy himself, the man who manages all the CI covered call ETFs, Mr. George Lagoudakis. So in this video, we will review CI Global Asset Management's lineup of covered call ETFs. They actually introduced one new one to the mix. They have 7 covered call ETFs total. We'll go through them really quickly. We'll analyze CI's specific covered call strategy. And then I'm very excited. We'll talk to George, the guy who actually manages all these ETFs, that has been managing them for a really, really long time. He's a no-nonsense guy that has a lot of experience managing options. And we'll discuss CI's strategies and CI's way of thinking when it comes to covered call ETFs. So strap in, let's take a look at all these great ETFs from CI Global Asset Management. We'll take a look at the strategy, what's inside, etc. And then we'll talk to the guy who actually manages them. Let's get to it. All right, everyone, CI Global Asset Management, pretty big ETF provider in general in Canada here. But in this video, we're really going to focus on the covered call ETFs because this is the passive income investing channel. So if you just go on their website here and scroll down, you will see that they have an entire section here, or you can click here, covered call ETFs. With a little diamond here, you click on the ETF lineup and you will get the list of all their covered call ETFs. They actually have 7 of them, but they do have .B and .U versions for a few of them. So if it's just the regular stock symbol, it's going to be pretty much the Canadian or the Canadian hedged version, which are more popular. But if you see a .B, it means that they're not hedged to Canadian currency, which means, you know, by the way, in case you're new and you didn't know this, if something is Canadian hedged, it means that the US dollar to Canadian dollar exchange rate will not impact the value of the fund. So the exchange rate between the Canadian dollar and US dollar is mitigated. If you get the .B one, you don't have that mitigation. So if the US dollar gets stronger, it's going to be better for you, basically. So if you really believe in the US dollar, you don't believe in the Canadian dollar, you would probably like the .B versions. If you just don't want currency fluctuations to impact your portfolio, you just want the stock price movements to impact your portfolio, you would go with the Canadian hedged version. And they also have US dollar versions of some of them as well with the .U. So let's review their 7 covered call ETFs in detail here. But before we do that, it's very important that we understand what is CI's covered call strategy. And it is a systematic set in stone approach that is quite different from everyone else. And you see that right here. So they write at the money call options. We know that when it comes to the covered call strategy, everyone, there's 2 major factors: portfolio coverage and the moneyness of the option. So at the money call options, that is the moneyness of the options. We know that at the money call options means you're pretty much giving up all the upside. So the strike prices are going to be more or less whatever the stock prices are, right? So if a stock is $100, an at the money call option means you're selling the call option at $100. So you're giving up all that upside, but when you're writing at the money call options, you're getting big premiums. So that is the moneyness. What about the coverage? Well, you have it here on approximately 25% of the portfolio. So very low coverage. Yes, they're at the money call options, but it's only on 25% of the portfolio. Most ETF covered call providers, it's 33 up to 33%, 50%. This is actually very low. It's on only a quarter of the portfolio, which means by default, you're pretty much capturing 75% of the upside of whatever the stocks do. So here's a nice little brief summary. We're going to go through them very quickly in a second here, but you could actually see, I love this document, by the way, because for every one of these ETFs, covered call ETFs, you could actually see how much yield they're making just on the covered calls. You see that here. The, of course, technology one being the biggest one, because we know that tech stocks are volatile, so the premiums are higher. but also what is the yield they're making just on the dividends from holding these stocks. So it's pretty high, right? Obviously you see the Canadian banks, they have high dividends, so it's almost 5% yield just with the dividends. And you have the list that goes on and on here. So I really like this. You actually see not many ETF providers, actually detail, okay, how much yield are we getting from the dividends, how much yield is coming from the options. So very, very cool document, which I suggest you check out. It's on their website. If you go to any of their covered call ETFs, you just click on documents and you will see that it is one of the documents there. So here it is, by the way, covered call ETFs. This is the document. So now let's actually go through their 7 covered call ETFs, everyone. Let's start with the most popular one, their technology one, TXF, the CI Tech Giants covered call ETFs. And by the way, their management fees are some of the lowest in the game. I think they're actually all 65 basis points, if I'm not mistaken. And the MERs are mostly, I think, almost all 71 basis points. So very low, compared to everyone else. It makes sense because CI is a bigger firm, right? Another thing to mention is that their distributions are quarterly. They are not monthly. So it's actually one of the only covered call fund providers that give quarterly distributions instead of monthly. I'll ask the covered call fund manager why that is as well. We'll talk about that, don't you worry. So let's go through the 7 ETFs, everyone. TXF technology, so obviously all technology stocks. This is a really big one, their most popular one, a little bit over 500 million here. So obviously you're going to see most of the exposure is in the United States because that's where all the best tech companies are. Here are the top 15 companies that make up 62% of the portfolio. So I'm guessing they'll probably have about 25 stocks. So it's just a mishmash of all the big tech stocks. Not only you got chip makers, you have electronics here, you have the software companies like Intuit and Adobe, and Google is here, but you also have the network providers like the Broadcom and Cisco. So broad-based when it comes to technology here. So that is TXF. And if you click on distributions, you could click on distributions tab for any one of these ETFs. You will see the approximate yield based on the last year or the last 4 distributions. And you see all the distributions here, by the way. I love the way they did this website because not only do you see all the past distributions, but if you scroll down, you actually see all the tax information or the tax breakdown of the distributions for every year since the beginning, since 2011. So we know that in Canada, 2011 was really the year that these covered call ETFs started coming out. So CI is definitely an OG in the covered call space. And it should be no surprise, technology companies, they don't have many dividends, if at all. So most of it is all going to be capital gains and return of capital, which is what covered call income generates, which is very, very tax efficient in a non-registered account. So I just wanted to point that out to you. You click on the distributions tab, you will get that. You click on the portfolio tabs and you will see the breakdown, the geographic breakdown, the sector allocation within the technology sector breakdown, as well as the top 15 companies. So TXF, very popular, very high yield technology. Next one is NXF, also very popular, that deals with energy giants. So this is going to be just oil and gas producers, no pipelines. You have all 15 companies here. So you basically have all the big oil all around the world. From Canada, you only have 2 companies, Canadian Natural and Suncor. Is Suncor here? Actually, yeah, Suncor is here, and here's Canadian Natural. So these are the only 2 Canadian ones, but you'll pretty much recognize all the other ones. You got Total from France, you have Enispot from Italy, ExxonMobil, Shell, Chevron, Equinor. So really, really the big cap, big oil companies. Here's the breakdown in terms of region. All energy here. So NXF, if you're into energy, energy's been doing really well lately. This is a great ETF to have. Very, very high yield of 9% as well here, estimated by looking at the 4 last distributions. Next one is CGXF, Gold Plus Giants covered call ETF. So this is going to be gold producers. And by the way, if you're not really noticing the theme here, these are all sector-based covered call ETFs. So they're really sector specific. Same management fee. How about NXF? Yeah, same thing. Same MER portfolio. Mostly a lot in Canada here, but of course South Africa, that's where some miners are, and you're gonna have really the big cap miners, the top 15. There's 15 companies in here. You'll recognize a lot of them, of course. Franco-Nevada, Barrick, Wheaton, Royal Gold, Newmont. So only the big cap, only the big boys here. Next one is CIC. This is Canadian banks. MER a little bit higher here than the other one. Same management fee, however, and of course, top six Canadian banks, guys. The big six banks are here with covered calls. And if you look at the distributions, it has an approximate distribution rate of 8.61%, which is pretty high for just the Canadian banks. Of course, like we saw in the document here, again, I love this document. You see that most of the yield is just coming from the dividends. Just very little is coming from the covered calls here. When it comes to the Canadian bank ones, FLI, this is just life insurance company, very unique. It's one of the only covered call ETFs that's only a life insurance companies. Management fee a little bit higher, MER a little bit higher on this one. If you just want to invest in the life insurance companies, this is probably going to be of interest to you. You see that it's just the top 10 life insurance companies in North America, mostly in the United States, by the way, 70%. From Canada, you got the three that you'll expect, right? Great-West Life, Sun Life, Manulife. But you have MetLife, Globe, AFLAC, all the big ones in the US, Lincoln, Principal. So this is just life insurance companies if ever you really want life insurance specifically instead of, banks and life insurance. Next one is FHI. This is their healthcare. So like the name says, it's going to be all the healthcare giants, which are mostly in the United States, right? So you see here that the top 15 companies make up 77% of the fund. So my guess is that there's approximately 18 to 20 companies. You'll recognize all of them, guys. These are just the big ones: Johnson & Johnson, Abbott, AbbVie, not only the pharmaceuticals, but also equipment and healthcare services as well, like United Health Group, which is really, really big, mostly in the United States. So this is going to take care of your healthcare sector, which is very underrepresented in Canada. So definitely an important one. Let's check out the yield real quick here. The yield estimate, it's approximately 6%, just under 6% here. And last but definitely not least, this is the new one, very recently came out on utilities. So this is a utilities one. The management fee, 65 basis points. MER is not there because it hasn't been a year. You see that the ETF came out in February of 2023. Look at the distribution rate. Even the distribution rate is not there yet, but because 4 have not come out yet. But if we look at the portfolio, one very unique thing about this, and I'll talk about it with George, is that it's utilities, but it's only electricity. There are no pipelines in here. So things like Enbridge, Pembina, not in here. There's no railroads and there's no telecom. So typically covered call utility ETFs like ZWU, HUTL, the one from Harvest, they have a mix of rail. There's also UMAX from Hamilton. There's telecom, there's electricity, there's pipelines. This is only electricity, so extremely defensive, very, very defensive here, and mostly in the United States as well, 90%. So a lot of the big ones in the United States, like Duke and Southern and Edison, et cetera, et cetera. There's a little bit of Canada too. Hydro One is here. So that is basically the entire lineup of their 7 covered call ETFs, all sector based. Why is that? Why did they? Why did CI decide on 25% only at the money calls? Why did they decide on this covered call strategy, which you could read in this document here, like we checked? And let's talk also about the new utilities ETF. I mean, why only electricity companies? Well, let's talk to Mr. George Lagoudakis, who manages all of them, and figure out what's going on with all these great covered call ETFs. All right, everyone, I am joined by George Lagoudakis, portfolio manager at CI, one of the biggest covered call ETF fund managers or providers in Canada. George, we've been trying to schedule this for a long time. I know you're busy. Thanks so much for taking the time. How are you doing today?
I'm doing well. Thanks for having me.
All right. So just to be clear, George, you are the portfolio manager for all the CI covered call ETFs, right?
Yes, I lead manage the covered call suite as well as our physical gold ETF. And I'm a senior member of the PM team for all of our index products as well.
Perfect. So you are definitely the guy I want to talk to. I always love talking to the covered call fund manager for any ETF provider. So George, just give me a little bit of background since it's your first time on the channel on yourself. If you don't mind, what is your experience? What is your background real quick?
Sure. So I'm, as I mentioned, a senior member of the capital markets team here, where we implement our rules-based and index-based products. I've been trading options or managing option portfolios for 17 years. So yeah, have the experience for this sort of product.
Interesting. Okay, thanks. So definitely a lot of experience with covered calls and writing options. So give me a little bit of, let's talk about CI's covered call strategy. So when it comes to covered call strategy, obviously we know the two most important things, the portfolio coverage and the moneyness of the options. Now, correct me if I'm wrong, last time I checked, CI does a systematic approach where you guys do at the money calls, but only on a quarter of the portfolio. So is it still the same strategy currently?
Yeah, it's very systematic. So we do sell on 25% of the holdings.
Okay.
It's not at the money. It would be, you'd have to trade OTC options to technically be at the money. So it's slightly out of the money, so we can generate a meaningful yield on that 25%. And then you're left with a 75% upside. We tend to focus on liquidity. So our underlying holdings are largest market cap, most liquid names on a North American listed exchange.
Yeah.
Um,
Okay, so is there a reason why, like most people do, well, BMO does, for example, systematic approach also. Why did you guys decide to do a systematic approach instead of an active approach? Is it you just found the magic formula? Is it because investors like to know exactly what's going on with these covered call ETFs? Why did you guys decide on this approach?
I think everybody is rules-based active, you could say. All right, just depends where you are on that spectrum in terms of, are you picking single stocks based on your fundamental views? Do you have a quant model to filter? Are you basing it on liquidity? What we found over time is that transacting in stocks, the most liquid stocks, and adding those to the portfolio really, add value over time. You want to maintain the majority of the upside. So you don't want to be capping, 50, 60, 100% of a portfolio typically. I mean, at the end of the day, markets are usually in the bull market, meaning they're
Right.
grinding higher more often than they're going down, right? So, I think another thing that's really important to understand is, while yield is important, and that's what these products are partly about, it's important that your capital grows as well, right? Because if you take, say, today's kind of economic environment with inflation and so forth, I mean, if inflation is rising 5-10%, you need your capital to grow over 5-10%, where you're selling, generating income off the options and so forth, right? So it's important that you think about capital and total return first, yield second, and then liquidity, I would say, right?
Yeah, yeah, for sure. I agree with that. And you're right. There is more bull than bear. So, okay, so you guys basically have, you have an energy one, you have a technology one. I think those are your two most popular covered call ETFs. What about the stock selection? Is that I noticed, and this is pretty much typical for these covered call ETFs, is the stocks don't really change that much. Are these? Do you really believe in the stocks? And you are bullish on the stocks in these portfolios, and how do you come up with how do you decide which stocks you put into these
Right.
ETFs?
Again, we're not taking a view on the single stocks. We're trying to give people the exposure they're looking for, and then generate a yield on that. Maybe they're buying the sector because they think it's going to rally and they want to be paid to wait, or maybe they think the sector is a little frothy and they want some protection to the downside by generating income, right?
Yeah.
So we really focus on liquidity, like I said. So we're picking the companies that have the largest market cap, most liquidity, and then selling options around that, right?
Okay, interesting. All right. So one question I do have, and this is, I see this question in my community as well, which, my channel, my community is all about income investing with a focus on covered calls. CI is one of the only fund managers or covered call fund managers in Canada that has quarterly distributions instead of monthly distributions, and every quarter they could vary. So why is that? Why do you guys do quarterly distributions, and are there any plans to actually change them to monthly?
Right. So these products were never set up to be monthly income funds, right? Dividends get paid quarterly, and because we pay out everything we generate quarterly, right? So
Okay,
people
you
can
pay
see what we
everything
generate,
again.
dividends plus all the premiums. So paying them out quarterly helps smooth that somewhat. But again, like, we're managing our products for long-term performance. We want to provide yield, but ultimately long-term performance is what we care about most. So we don't want to be managing to the payment, right? Like, if you go to a monthly payment, often you'll have to pay less than you generate because maybe some months, less income was generated and you got to make it up by other months. Maybe you have to sell some shares. So it's just a little bit of a different management style, right? Again, we're focused kind of on long-term performance and not meeting, a super frequent distribution.
Okay, fair enough. And I've noticed that CI has a lot of, or pretty much has, when it comes to the covered call suite, sector based, sector specific. You got the gold one, the energy one, the tech one, even the utilities one now, healthcare. Why only sector based? Is that done on purpose? Like, how come you don't have any broad based, like overall Canadian market, overall US market type of covered call ETFs? Is there a reason for that or a reasoning behind
Right.
that?
So in the past, we did. There just wasn't a lot of interest. So that
Okay.
product was closed many years ago. So it's possible we might do something like that again. But investors tend to be thematic these days. They have a view on something, a specific sector. AI, whatever it is.
Yeah.
So I think that I think investors do like to be able to be concentrated in the sector and be able to switch when things are working and not working. Um, but yeah, that's not to say we can't launch one. As you know, we launched the utilities, so we have all the sectors covered. If we wanted to do a fund to fund, so to speak, or it's possible. Just comes down to we don't want to do it just to do it. We want to do it where we think we're going to add value. Like every product we launch, we're launching it because we think we're going to get the best performance in the space, right? That's kind of how we approach things. So if we do, we would do it and have some kind of a strategy behind it, likely to add value there.
Interesting. Okay, and you kind of just mentioned that this was going to be one of my next questions, a fund of funds. So there's a lot of very popular covered call ETFs. They are funds of funds, right? They're whether it's they hold third party funds or just the fund manager's own funds inside of them. Is CI thinking about doing an all in one fund of fund? Maybe just add all the CI ones on an equal basis. What do you think of these all in one covered call solutions?
Right. I mean, I can't talk about future launches, but
For
we're
sure.
always evaluating and to see what kind of products we can launch. Like I said, that we believe are going to perform and do well by our clients. Yeah, I think there can be value there. What I would say is you would want to question whoever's running these products, like what is the value added in that structure, right? Like, is it just equal weight and the exposure is the exposure and that's that? And if markets go down, too bad, so sad. Or is there some decision making? Do they rotate around? Do they have some kind of quant, background or some systematic or fundamental reason to make decisions? Because you want to add value. That's in any product that you launch, right? So, yeah.
Okay, and there's another trend that's happening now. They're very popular. I really like these ones because you talked about long term. We talked about long term investing, right? You're holding for the long term. There's a lot of leveraged or modestly leveraged covered call ETFs that are coming out. It's typically 25% leverage, which is not that much. CI doesn't have any leveraged covered call ETFs yet. What are your thoughts on those? Any I know you can't talk about future launches, but are you thinking of maybe launching covered leverage versions of your covered call ETFs?
Yeah, again, that we'll have to see, I guess. But what I would say is, so leverage, it can be good and bad, right? It
Yeah,
just amplifies path dependency, so to speak. So if bull markets are going to grind higher and you add some leverage, then you'll probably benefit. And if they're going to go down, well, then you're not going to benefit, right? So that's kind of, I think once you add leverage, it also depends like who is buying the products, right? If you're in your retirement, things like that, and you can buy a product that already generates a meaningful yield, like our products probably range 6 to 10% typically.
hmm,
Do you need that leverage? Because the thing is, you have a couple of years where there's a drawdown and you amplify your downside and your capital goes down, and then maybe you need your capital and now it's much lower, right? So you just have to be a little more careful, I think, in how you think about that. And if you're investing in them, you should be kind of asking the managers, like, do they do anything to mitigate leverage to the downside, or is it just a pure up and down exposure and whatever happens, happens? The other thing I would say is that also the cost of leverage, right? Like some of these, now maybe the concept is that you're using leverage also to magnify the yield, right?
yeah,
But rates are not near zero like they used to be or low, and
true.
they're rising. Not only are they higher, but they're still rising. So does it make mathematical sense? Are you really adding anything there by borrowing at this time, right? So there are certainly things to think about when you invest in those products, and they can be used to an advantage for sure. But you should be aware of the risks and certainly be asking how maybe those risks can be mitigated. And
Interesting. Okay, yeah, it makes sense. I mean, you're right. The costs are rising for sure. So definitely a consideration there. When it comes to the covered call space, I mean, the last couple of years have been explosive in Canada. All kinds of new products coming out. Everyone's just trying to one up each other, right? Similar products, very, they're advertising very, very high yields. How should investors look at this or and navigate all these, all these options now in the covered call space in Canada? What do you think about that?
Yeah, I think like one of the comments I made earlier is that you should care about your capital. Like you want return, right? You want total return. So if a yield is 15 or 20%, that's great. But what does that mean for your underlying capital? Like, is it going to go down? Is it going to stay flat? Is it going to rise at a very, low rate? Whereas, a product that has a lower coverage will rise more, right? So I think that's something maybe that's possibly being missed by investors, is that maybe they're buying the yield and not looking at what the total return is going to be, or what the sacrifice may be for capping too high a percentage of the options, right? Especially when you're selling very close to at the money, right?
Yeah.
If you're doing it further out, you can go to a higher percentage with less downside, obviously, right? So that's one thing I think is important for people to think about, is not only the yield, but the capital. What's going to happen with the underlying capital? Because you do need to grow your investments, especially when we're in a time where inflation probably is going to stay elevated for some time, right?
Okay. Yeah, I'm hearing a consistent theme, and obviously you're very, very concerned about the capital, and don't want to write too much cover call not to give up. And that's, you guys do have one of the lowest percentages of coverage, 25%. Typically it's 33 or 50%. So I'm understanding that, yeah, really focuses on capital preservation, which could be a
Yeah.
great thing for some
Well,
investors.
it's not capital preservation. It's performance, right? Because if you look, we launched products pretty early in this space, right? It was
Yeah.
2011, right?
Yes.
So we've been doing this for a long time. And there were experiences before that in the closed-end space, I believe, selling at higher percentages, and kind of those lessons were learned, right? So when you look, if you were to look at like absolute and relative performance of our products versus some of the alternatives, you'll see that they compare very favorably, which is the reason we've won Fund Grade A Plus and Lipper awards. So it's not just about capital preservation. It's
Total
growing
return.
and performing. It's total return. That's right.
Okay.
And we don't want to sacrifice that to be able to show, say, a yield 2 times what we're currently generating, just to have people buy that. And then maybe short term, it makes sense, but 5, 6, 7, 8, 10 years down the line, it's like, well, I underperformed a strategy that was done differently, right?
Yeah. Yeah, well, that makes sense. I mean, this definitely could be, obviously total return is very, very important, and it could jive well with certain investors that want the extra yield, but they don't want to sacrifice too much that total return. So you recently launched, so, you have the tech one, you have the energy one. You guys recently launched a utilities one. And let's talk about that. And then we'll talk about, you actually launched mutual fund versions of all your covered call ETFs, if I'm not mistaken. So let's start with the utilities one. Why did you guys
Yeah, sure.
decide to launch that one?
Yeah, so utilities, 2 main reasons. One is liquidity. I think some of the competing products focused a little more on Canadian utilities and things like that, whereas we are focusing on companies listed on the North American Stock Exchange in terms of market cap and liquidity. So our product is, it's going to be more liquid holdings. And ultimately that benefits performance, right? When you have to trade every month into positions and out of positions and rolling options and all that kind of thing, liquidity matters. I mean, it matters even more in the option market where spreads are wide, right?
Yeah.
It's not like trading, Apple or something. You know what I mean?
Yeah, yeah. Yeah, I did
So
notice
that's
that. I mean, I'm looking at of course, we're talking about the CUTL
yes, that's
ETF
right.
here, which you have a Canadian hedge and a non-Canadian hedge version. But I see 90% is in the United States stocks like
That's right.
Duke and Exelon and Edison
Yep.
and
Yeah, highly liquid.
Southern. These are all big, big liquid.
Yeah.
And
So
I,
yeah,
I,
I
I-
think one thing you've noticed, like, because market structure has changed, over the last several decades, right? And a lot of money goes into passive, right? So they're buying the large cap stocks, which feeds on itself, right?
yeah,
80% of the market is in trading now is like high frequency trading, and quants, trying to trade against the other 20%, right? So things have changed, and liquidity is important. Like I mentioned before, when we talk about active management, single stock picking is just one aspect of it, right? There's a lot more to it now, and it's, trading a position, when to trade it, how to trade it, and then which names you're going to add to a portfolio, so you don't have to keep booting them out and then adding them back and booting them out and adding them back, and then having negative performance consequences, right? So yeah, it's definitely important, right?
Okay, so what about the mutual fund versions of these covered call ETFs? Why did you guys decide to do that? Aren't ETFs more cost efficient? Is there a reason behind that?
So the one more comment I want to make on the utilities, if you don't mind, and then
Sure,
we'll
sure,
talk
of course.
about that. And the other one is pure exposure, right? There are other alternatives where they're adding telecom and energy
Railroads.
pipelines and things like
Yes,
that.
yeah,
But the truth is, when you look at correlation, those sectors don't correlate with utilities, right? They're not as defensive as utilities are, right? So if you're going to go buy a product like that, and when utilities are supposed to shine, they're not shining as much as they should because of these other sectors that have been commingled with them, right? So that's another reason we launched this product. So it's pure utilities.
pure
There's
use. So we're
nothing else
talking about
there.
electricity, no
Yeah, it's
telecom, no
that's right. No
railroads, no
telecom, no
pipelines.
pipelines. No, it's pure. If you think bond yields are going to turn down again, and you want a equity like fixed income or whatever you want to call it, right? Then
Defensive, very
that's, yeah,
defensive.
exactly right. So yeah, we wanted a pure sector that's going to do that, right?
Everyone needs electricity, right? I mean,
Right. Yeah.
it's a no-brainer.
Exactly.
So yeah, that makes
Yeah,
sense.
so with the mutual funds, we're fortunate here to be able to be product agnostic, and we wanted to offer, products that we believe are quality products, performing products that have won awards and so forth, not only to ETF investors, but to all investors in Canada. And that's the reason we rolled out four of our covered calls into the mutual fund space. The fees are the same in terms of the management fees, so
Oh,
there's no
okay.
difference there. So that allows anybody to buy it. So we launched the gold giants, all the gold miners, the tech, which, as you said, is popular, the energy as well, which has been popular, and of course Canadian banks, which yeah, everybody has Canadian banks, right? So
Yeah. Okay, sounds good. Yeah, I mean, why not? You might as well give the choice. I understand there's some more, investors that are still with financial advisors and they like their financial advisors. This is just a way to get some covered call
yeah,
exposure without opening your own account, and you just tell your advisor, "Oh, get me some of these mutual funds. I want some yield. I want some extra yield in the portfolio without sacrificing management fees," right? Since you said they're the same, right? So I think that's could be an interesting option. So Georgia, you answered pretty much all the questions I had. I think maybe we'll leave off with one more, and this is something I ask pretty much every cover call fund manager that I talk to. So when it comes to cover call ETFs or mutual funds now, in Canada, there's a lot, right? There's a lot of competition. You got Hamilton, you got Horizons, you got BMO, which is the biggest one. Why would investors or do-it-yourself investors that want to get in on these ETFs in this space choose CI instead of the competition? What would you say?
sure, sure. Yeah, I think there are several reasons. I mentioned track record before. We've been doing this for a very long time, not only at CI, but also myself, as I mentioned, 17 years trading options and managing option portfolios. So the experience and the track record is there. And when you look at performance as well, I recommend anybody who is looking at buying some of these products should always look at total return and performance. And I think, the performance on an absolute and relative basis validates kind of our systematic rules-based active approach here. It's they're performing well. Won awards, as I mentioned, Fund Grade A Plus and Lipper Awards. So I think the performance is strong. We've, like I said, we have the track record that we show we can grow capital, and we can pay what I believe are high yields in the 6 to 10% range. Typically, it's been the last several years. Tax advantage, as you know, from the premium side of things. So I think it's a compelling case if you're interested in this product space. Our structure allows for strong upside because we don't cap 75%
Yeah.
and generate a meaningful yield on the 25%. So I think it's something worth considering for any of your subscribers or investors who are going to watch this if you're looking at this space.
Yeah, no, I completely agree. Definitely have the track record. I would also say that management and MER fees are very, very competitive, some of the lowest in the space. The yields, like you said, are really good. And I kind of get now where, you do have mostly a lot of US big cap stocks in there. Like you said, liquidity is very, very important, especially in the option space. CI, obviously, brand name is really good and with your experience. So I think all in all, I mean, income investors should definitely think about the CI products if they're really looking for total return as a priority. They want some yield, but they don't want to give up too much. I think 25% is one of the lowest coverages in the space, and that could go perfectly well with investors who have those priorities. So George, I think that's pretty much it. So thanks so much for taking the time. I know you're a busy guy. We've been coordinating to try to do this. I really appreciate it. Come back anytime, and we'll be following any new products launches, of course, and hopefully you could come back and we'll discuss them as well. So George, thanks again, my friend, and hope to see you again soon on the channel. Take care.
Yeah, for sure. Thank you so much for having me. It's been a pleasure.
Thank you.